Today, we're going to do something a little different. We are stepping right into the shoes of a professional market analyst on a morning where the screens are flashing red and the stakes are incredibly high. We're going to break down their playbook minute by minute.
Okay, picture this. It's 6:19 a.m., well before the market opens. You pull up your main analysis report, and this is the very first thing you see, in all caps. This isn't just a friendly heads up, it's a command, and it's about to set the tone for the entire day.
So what's the big deal? Why the alarm bells? Well, it all boils down to this one number, 17.17. Now, to most people, that's just a random number, but to a professional, this is the first little tremor that warns of a potential earthquake. But what is it actually measuring?
Well, that number is the reading for the VIX, the volatility index. You've probably heard it called the market's fear gauge. Now, what's so critical here and what the source material points out is a very specific line in the sand. Anything over 16.5 is considered a major shift. We're already well past that point. So this isn't a drill, it's a clear call to get defensive and fast.
So, what's actually causing this? Let's dig in and unpack exactly why the market is flashing this very clear warning signal.
To really get a handle on the risk, an analyst looks at all the evidence on the board. They're not just staring at one chart. They're like a detective, piecing together data from all across the market to build a complete picture of what's going on.
And this is what that board looks like. The S&P 500, the broad market, is under pressure. You've got Tesla, a classic high beta stock, meaning it moves more dramatically than the market. It's showing really weak momentum. And even Bitcoin, it's just kind of stuck. The really crucial takeaway here is that nothing is showing any real independent strength. Everything looks shaky.
And this points to the real danger here, something called cross-asset convergence. You see, normally, you'd want different assets in your portfolio to act, well, differently. But right now, they're all moving together, in lockstep. That means weakness in one area just cascades right into the others. Your normal diversification doesn't help as much, and the risk gets amplified across the entire market.
So, once that risk is crystal clear, the focus has to shift immediately. It's no longer about hunting for the next big winner. It's all about creating a defensive game plan to protect the capital you already have. This quote right here, this is the core principle of that whole game plan. Convexity plays is just a fancy term for those high-risk, high-reward, swing-for-the-fences type of bets. The message is clear. Forget about hitting home runs. When the VIX is this high, job number 1, 2, and 3 is preserving your capital. Okay, so how does that big idea turn into concrete action? Well, it breaks down into 4 immediate steps. 1, you reduce your position sizes, especially in those volatile names. 2, you tighten up your stops, making your automatic exit points way stricter. 3, you limit the really risky stuff like those zero-day options mentioned on the slide. And 4, you get your hedges, that portfolio insurance we talked about, ready to go.
All right, the plan is set. Now it's time to look at the specific plays analyst is prepping to execute the very moment that opening bell rings.
And let's be absolutely clear, before there's any thought of making new money, the focus is 100% on defense. You can't play offense if your defense is full of holes, right? So priority 1 is, and always will be in this kind of environment, hedging.
So what does that hedge actually look like? Well, the main play here is buying VIX calls. These are basically options that pay out if the VIX, the fear gauge, goes up. The logic is so simple. It is literally like buying insurance on your portfolio. You're betting that fear is going to rise. If the market tanks and volatility spikes, this insurance policy could pay out big and help cancel out some of the losses you might have elsewhere.
But here's the kicker, and this is so important to remember. Even with all this data pointing one way, there's almost never a single right answer. And here we see a perfect example of that. On the left, you've got the defensive, cautious analysis we've been following. But on the right, another professional report is looking at the exact same data, but they're seeing short-term bullish momentum and actually recommending bull call options, a bet that prices are going to go up. 2 valid data-driven analyses leading to completely opposite conclusions.
So let's zoom out. The key here isn't to memorize specific plays or stock tickers. It's about understanding the professional mindset behind all of these decisions. This is the real takeaway on how to manage risk when things get choppy.
So what is that professional mindset? It's really a repeatable framework. First, volatility comes first. Every single decision gets filtered through the lens of the VIX.
When uncertainty is high, you size down. You put on your hedges before you're desperate. You keep cash ready on the sidelines for both defense and opportunity. And you never ever set it and forget it. You are monitoring constantly because things can change in a flash.
And you know, that really brings us to the final critical question. In a world with endless data, a million conflicting signals, and high-speed computers, is it possible that the single most powerful strategy isn't some secret formula, but just a disciplined, repeatable process?